The personality of waves. This lesson is an important element of the wave theory of Elliot to properly understand what is happening in the market at the time of the wave. Elliot's theory shows because human behavior is using technical formations. Each wave in Elliot's theory reflects the psychology of the crowd community. Mood swings from pessimism, optimism, to the euphoria and vice versa. Personality of the waves is very clear whether we are dealing with the supercycle or microcycle. These specific features do not inform us only about what development of the actions we can expect, but it also helps in illustrating the current market situation, if we have more than one of the interpretations to choose from. The theory of Elliot provides us with sometimes several orders of waves, and in such cases knowing the personality of the waves may be priceless and lead us to choose the formation corresponding in line with the market. The Elliott's wave model, the impulse wave. Wave 1. Occurs the jump from the levels of the undervaluation. The hope for the better time occurs. Bottom. Wars, crises, recession, limited conflicts, bad news. In most cases, the first wave is strong, corrected in the second wave. This is because many investors are convinced that the overall trend is downward. There is such a belief because there was not yet formed a basis for the reversal. Investors do see mass sales. What causes strong recovery of previous increases? In other cases, the first waves are formed from previously created structures correction. In such situations, the first waves are very dynamic and undergo small adjustments. Wave 2. Fundamental conditions are as bad as in the case of forming the bottom. Still, the conviction prevails that the main trend is downward. Wave 3. A powerful force. During that period of the third wave, it is best fundamental situation, economic development. Therefore, third waves are usually elongated and never are the shortest. Wave 4 can be summed up as a surprising disappointment. It is a signal of the trend of the biggest phase of growth. Waves 4 are more predictable than any other because we know thanks to the rule of variation about its characteristics. Typically, and this is a horizontal wave, creating such a perfect base for Wave 5. Wave 5, the last increase before the crisis. A fundamental image is good, but not as great as during the formation of the third wave. Emotions prevailing in the market and the need to repeat the success of the third wave cause a state of reevaluation. The Elliott's wave model, the corrective wave. The peak. The peak on high stages is mainly characterized by the good economic conditions or lack of wars. Investors tend to think that this state would last forever. On the middle stages, the peak could occur as an improvement of the economic situation, and on the lowest stages as simply good fundamental news. Wave A, breaking the trend line defined by pits of the second and fourth wave. The situation here is seen as a good buy signal. On the bear market, investors perceive such situations as a stronger correction and looking for a good place to buy. People ignore the signals that are coming. The 5-wave structure of the A wave generally promises waves B in the form of a zigzag again. If there is a triple wave, we can expect a triangle or a flat correction. Wave B. Wave conditioned mainly fundamentally. You can call it a wave trap. It is the bane for greenhorns who fall into euphoria of the returning bull market. The same qualities can be attributed to the wave X and D. Wave C, the worst phase of the bear market. Everything falls down rapidly at the reaction in a form of a collapse of the foundations.